videos, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Great you can join us. This is where we wrap up the day and the week. What a week it's been. Very busy certainly here at AusBiz as we try and get across all these results that are coming to us. 1 week left, in fact, of reporting season. And we're going to get a few stragglers in the week after that, particularly looking forward to some small caps, which tend to report at the tail end of earnings season. So, taking a look at where we're likely to finish, pretty flat, in fact, marginally negative. Made a bit of a comeback there late in the morning, and that's pretty much where we're likely to finish up for the day, bearing in mind what we saw yesterday too, of course, that intraday record highs. So the ASX sitting comfortably above that 9,000 point level. Let's get to the themes of the day. Friday fizzle, I would call it more of a flat Friday, essentially. Tech troubles, and we forgot to fill that in, didn't we? Also, one more week, that was the third one. It is one more week till, well, I guess the official end of the reporting season, but as I said, we'll have some more to come after that as well. Let's check in on the sectors, what has been moving today. And taking a look myself, I don't know that we have the sectors up there, but nonetheless, the banks, again, doing much of the heavy lifting, maybe trying to get us back into the green today. We've got the likes of ANZ, Westpac and CBA all up more than 0.5% at this point. Materials somewhat mixed. Now, Rio having reported today, I'll get into some detail on that in just a moment, but it is off by 3% on a miss there. Some other notable movers, Guzman y Gomez tumbling. Just questions persisting there in terms of its aggressive expansion, particularly into the States in a saturated market there. And QBE doing very well. The insurers, well, certainly we've seen they have done relatively well recently. Last week they were hit, certainly on AI concerns. This week they have been doing well, particularly those private health insurers, given the government has allowed them to lift those premiums yet again this year. Let's get into some of the detail then. Telix Pharmaceuticals posting a full year net loss of over $5 million US. Revenue for the year rising more than 50% to just under 804 million, surpassing guidance. It's guiding to nearly $1 billion US in revenue. Taking a look at what else were Ingham's, the net profit there slumping as the poultry producer for the first half year fell amid rising costs. Interim net profit falling by some 2/3 to more than $18 million, saying that earnings were hit by higher costs driven by excess inventory and supply chain transition. Elsewhere, Guzman y Gomez shares falling after reporting softer sales than expected. The Aussie-listed Mexican-themed food chain posting a net profit after tax of $10.6 million for the half year, up 45% on the previous and above estimates for Guzman y Gomez. All right, so actually just a quick check of those other stories. Rio Tinto seeing flat annual earnings for the year amid low iron ore prices. We've got the five movers there. Mineral Resources delivering a record first half revenue of 3.1 billion. That's up 33% on the corresponding period. QBE, as I mentioned there, reporting a 21% increase in full year net profit to $2.16 billion. And Cube, in terms of logistics, seeing interim net profit double after the sale of land in Victoria. Megaport also rising on FY26 forecast upgrade and an upbeat half year revenue. All right, let's unpack the week as we do every week with Shane Oliver from AMP. Shane, welcome back. Good to see you.
Good.
All right, we're sort of officially, I guess, 3/4 of the way through reporting season. What's your takeout been just in terms of those companies now the earnings looking fairly positive, you would think?
They certainly are, Andrew. Big turnaround in the miners, of course. That's been a big part of the story. They've gone from minus 15%, several years of falling profits, so they're now seeing earnings up circa 30%. Obviously, energy is still a bit of an issue, although what depends there on what happens to the oil price. But the key to me is that chart there, which shows the number of companies reporting results above expectations running at 48%, number of companies underperforming expectations at 26%. The differential between the two is the best it's been since we were coming out of the pandemic back in 2021. So we are seeing some very good results coming through here. If you strip out the resources stocks and the banks also doing pretty well in terms of their earnings. If you strip those two groups out and just focus on the rest of the market's not so strong. It's up about 4%, but it was also positive last year. But the basic picture is one of a shift from several years, 3 years in a row of falling profits, to now seeing rising profits. We've now got something like 66% of companies reporting dividends up on a year ago, far better outcome than the last few years. And likewise, we're seeing something like 64% of companies reporting profits up on a year ago. So yes, we are seeing the turnaround, and that's basically why the Aussie market's been able to flirt again with record highs.
Indeed, we saw that yesterday, that intraday high. Shane, though, should we be concerned that it's fairly narrow leadership, as you mentioned there? Certainly the big miners, the big banks that are really doing the heavy lifting at the moment.
Yes and no. I think, well, the banks have been a fairly strong story for many years now, so that never seems to go away. They just keep reporting good results. The miners are quite cyclical, but just bear in mind they were in a funk for, well, how do you say that? Funk or flunk? For many years now. And so they're turning around, supported, of course, by higher copper prices and metal prices generally. Big surprise there was that copper is now a bigger share of BHP earnings than iron ore is. So yes, that's a cyclical swing up, and I guess you've got to be cautious about that. But if you look at the overall stock in the market, the average stock is seeing profit growth of around 4%. Normally you'd say that's not too bad in the great scheme of things. If you get a 3.5%, 4% dividend, you put the two together, you get a total return. If capital growth equals the rise in profits, you get a total return of 8%, so that's not too bad. So overall, I'm not too concerned. I'd be a little bit more concerned about the high valuations on the market, 20 times forward PE, little risk premium relative to bonds, and obviously risk coming out of the US, Iran, what Trump might do. Midterm election years tend to be volatile, and of course the RBA potentially hiking rates again. So they're the main threats, but I think the profit story is a very positive one. There is also, I guess, a longer term positive for Australia here, which might sound a little bit perverse. We don't have a lot of AI or companies producing AI. We do have some, but nothing like the US has. But going forward, I suspect the beneficiaries of the AI story will be users of AI, and Australian companies will get that benefit. And also, you could argue that AI is akin to an increase in the size of the labour force. More robots come into the workforce run by AI, then that's an increase in the size of the labour force. And if you look about factors of production, if the supply of labour goes up, it usually increases the value of the other factors of production, like natural resources. So it could actually mean more demand for the raw materials that Australia produces. So longer term, we might actually be a key beneficiary of AI, if indeed it does lead to a big increase in global GDP.
Yeah, that's an interesting way of looking at it, because of course there was a focus on jobs this week, of course, with both wages and also those overall jobs numbers. What did you make of that, Shane? We did see an increase there, the unemployment rate staying where it was.
That's right. So I was a bit surprised again. The jobs numbers often surprise us, so maybe we should be used to surprise, but the key is the unemployment rate stayed at 4.1%. We got another month of good jobs growth, 18,000 jobs, but that was after 65,000 jobs the month before. So put the two together, looks pretty good. Unemployment, as I said, down, hours worked was up. So overall, it's telling us the jobs market is still fairly tight, or to borrow the words from the Reserve Bank, I think they say slightly tight or somewhat tight or something like that. And so the basic story there is capacity constraints still maybe remain an issue in the labour market, and of course that in turn supports reasonably strong wages growth. And you can see here that low unemployment has gone hand in hand with strong wages growth. Low unemployment, the red line, and of course the blue line is wages growth. And recently wages growth has been running around 3.4%. So that's, on the one hand, to be a typical economist, on the one hand there's a big positive there. Households getting more income, or nominal income at least, plenty of jobs out there. The negative, though, is that the Reserve Bank might look at it and say, well, yeah, maybe we can or we'll have to raise interest rates again. I hope not, but that's certainly a risk in all of this. And I just recall going into the last meeting back in early this month that we got a strong jobs report. Then we got an upside surprise on inflation. Then the Reserve Bank went bang and hiked interest rates in early February. Maybe there's a risk of the same thing this time again. Strong jobs report, just seen the inflation numbers next week, and then obviously they will set the scene for the what the Reserve Bank does in mid-March.
Okay, so that's certainly of consideration. Shane, also a consideration for investors is what's going on geopolitically with that threat that the US is going to strike Iran. We have seen those oil prices rise as a result. Perhaps surprisingly, gold has tempered some of those gains. How do you see this playing out if they in fact do launch a strike?
I guess it depends on the nature of the strike. I mean, there's a big issue here that Trump loves maximum pressure, come in really tough, punch people in the face or whatever it is. Maybe we saw a bit of that with Greenland, and then ultimately he backs off because he gets what he wants. And so maybe that's what's going on here. The military build-up is just maximum pressure on Iran with the hope that they will announce a deal. I think Trump is reluctant to get into a full-blown war or another forever war in the Middle East. His base won't support that, and he doesn't want to see oil prices spike. So there's constraints on what Trump will do. There's also constraints on what Iran will do. But Iran would have to know that Trump is kind of serious. He started dropping bombs on them a year ago, or June last year. So he is serious there. So I think, first step is Trump is trying to get a deal on nuclear capabilities in Iran and them to stop or wind that back, and of course for them to stop supporting terrorist activity in the region. If he doesn't get that, then I think you'll see some sort of surgical strike. Initially, I think the oil price will spike higher, possibly pushing above $70 a barrel, but then a lot depends on what happens to Iran. What does it do? Does it retaliate? Does it block the Strait of Hormuz on a semi-permanent basis, or try to anyway? Does it adverse or try and blow up oil production facilities in its neighbouring countries? And that's where the risks kick in. The market will initially fear that, and then you'd have to see how Iran responds. And if Iran does respond, disrupting global oil supplies, then of course you could see the price spike above $100 a barrel. But assuming the worst case is a dangerous thing to do here for investors, because some investors started to assume that back in June last year, and then it all fizzled out. There was a missile attack on a US base in Qatar, and that was the end of the matter. So maybe the same thing happens this time around again.
Well, yeah, it doesn't necessarily pay to try and second guess Donald Trump, does it, Shane? Let's hope.
That's right.
Yeah, let's hope cool heads prevail on both sides. Shane, have a terrific weekend. Thanks for joining us on AMP.
Thanks, Andrew. Take care.
Let's now turn to our stock of the day. It was Telix Pharmaceuticals, having reported earlier this morning, the nuclear medicine company guiding to near $1 billion in revenue next year. Let's hear from our experts, Thomas Atkinson from FX Evolution and David Lane from Ordinary.
The first earnings in a while where we've seen a little bit of surprise, and that's causing a slight bid. I think you've always got to be careful. I have a saying, and that saying is that if you have a freight train coming down, then you usually need a bit of market structure to actually solidify a base pattern, and this certainly has been a bit of a freight train coming down. So for me, some of the levels to watch in the future, $11 kind of 85. If we break above that, I think that the market is starting to recover.
We're a bit more positive on it. We like the business and think that it is an excellent business going forward. They have a lot of really good products that will hit the market, and I guess you look at the result today and you think, well, the company's recorded a loss. How does the share price go up? Well, it's really the fact that they are investing heavily into research and development and also into a lot of their new therapeutics. So the company has forecast that they'll spend around $200 to $240 million on R&D in the next 12 months.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN. Retirement income done differently.
All right, so let's turn to the winners and losers in today's trade, beginning with those in the green off the back of that result and what's ahead for Telix Pharmaceuticals, certainly the outperformer, up almost 15%. QBE, similarly, a very strong result reflected on those market moves. Austell winning a new $4 billion contract with the Australian Defence Force. Bega having reported. Treasury Wine also back on the winners list, whereas those that have lost out today, Guzman y Gomez, having tumbled, was down a greater amount. So in fact, I think that's it's fallen to a record low. Mind you, it hasn't been listed for all that long. Nonetheless, obviously concerns there in terms of its growth expansion in the US in particular. Megaport also having reported. Liontown and Mineral Resources, interesting. Mineral Resources was out today, but it is those lithium miners there, those three lithium miners listed there, with the lithium price having come off as well. In the smaller end of town, so Fortify up 30%. Yogi also on that list up 15%, and some of the resource stocks as well doing well. Those on the negative side. Alliance Aviation was also out with results today. That was poor, and it's been reflected on the market as well. Calix also out as well. So overnight, we get S&P Global PMIs, also a delayed read on US quarterly economic growth in GDP data. Next week, now locally, that key will be key data read there, inflation. CPI for January comes out on Wednesday, as we were just talking about with Shane there. That's going to be the next piece of the puzzle that the RBA is going to consider ahead of its next meeting next month. Will it or won't it move again? And earnings season, of course, continuing. Some more heavy hitters ahead, including Woodside, Karoon, Coles, ASX, also Aussie Broadband, and we're going to be catching up with a number of those chief executives off the back of their results. All right, so let's recap where we're likely to finish. So marginally lower, making a bit of a comeback after a fall out of the blocks there. Taking a look at the ASX, we're currently off by 0.05%, so pretty flat. Having hit that intraday record high, ASX 200 at 9,081 points. And that's where we're finishing the week. Thanks for watching and listening.